So there are people who love SCHD and there are people who love SCHD. And honestly, what's not to love? She's been with us through thick and thin and she's outperformed almost every time we've asked her to. But will she stay true to us? Will she always be there to outperform when we need her to? Now, I should actually probably start by actually telling you what SCHD is in case you're not familiar with it. So SCHD is the Charles Schwab Dividend Equity ETF. And over the past 5 years, SCHD has actually been up over 72%. I put this into context because maybe you don't know if that's actually good. The S&P 500 index, which is the index that we usually track ourselves against, many of us investors do, that index is only up 44.51% over the same time period. And this is with reinvesting dividends. And the thing with SCHD is that it pays a lot of dividends. And that's one of the reasons many dividend investors do love it. So, okay, the performance of SCHD is amazing, but why and how? And that's the thing I don't see many people on YouTube talking about. That's what we're going to talk about right now. So this is how SCHD works. I made this graphic for us. And so what we're looking at now is how SCHD works. This is a graphical representation of how this entire ETF works. And so what you have is you start here with these 2,526 potential stocks, and you have to go follow this green path all the way until you get only 100 stocks that end up making it into the SCHD portfolio. How does it do that? How does it get rid of all these different stocks and distill it down into just 100 stocks? This is how it does it. It starts with the Dow Jones Broad Market Index. That is the index that it gets its potential stocks from. There's 2,526. Now, first thing it does, it says, okay, we don't want REITs or real estate investment trusts. It does not invest in those. So I did an approximation. There's around 225 REITs inside the United States trading. So let's say there's 2,301 non-REIT stocks. Okay, now we have that. Okay, let's distill this a little further. Let's go ahead and say we're going to do these 3 different things to define the universe of stocks that we have. So the first thing is to make it into our universe here is you have to pay 10 years of consecutive dividends. So if a company pays only 9 years of dividends, it's not going to make it in. Or if it pays 1 year of dividends or no dividends, it's not making it in. It's got to be at least 10 years of dividends. And then you have 500 million of market cap adjusted float. Basically, that's just saying how big the company is. And that's actually not a huge company. So these are pretty small cap companies that can still get into this portfolio. 3-day average daily trade volume of 2 million plus. So that's just saying how many shares are trading on the exchange. So 1,851 stocks do not pass this test. They don't even make it in. You only have around, let's say, 450. Now, I'm doing approximations here, but I think it's probably close to this amount. So let's say there's only 450 stocks left after you get your universe of stocks. So of the 450 stocks that we have potential that can go into here, only the highest ranking stocks based on these factors are going to make it into the portfolio. That's 100 stocks. 350 stocks are probably not going to be able to pass the test to get into this, right? So it's only the best of these 450 based on these different factors. So to really truly understand SCHD, we need to understand this part. So let's understand that part. The first factor we have is IAD yield. The second factor we have is the 5-year dividend growth rate. The third factor we have is the return on equity. And the fourth factor we have is the free cash flow to total debt, and zero debt is going to be ranked first. Okay. Let's figure out these different factors because it's very important to SCHD and understanding if maybe it's going to keep outperforming in the future. Okay, so first off, IAD yield. This is the indicated annual dividend yield. Basically, just think of it as the dividend yield. What is the IAD yield? Well, it helps rank higher dividend paying companies. So companies that have higher dividends based on its dividend yield is going to be higher ranked inside SCHD. That is a factor. So if you want to know the formula of the IAD yield, it's just the annual dividend per share divided by the share price. Pretty easy. It's just the yield of the ETF. Okay, SCHD has a yield of 3.32%. What does that mean? Well, if you invested $10,000, you're going to get $332 back annually for investing inside this ETF. That's pretty good. Well, is it? So let's compare that to the S&P 500 index. S&P 500 index, 1.56% yield, so it's got a lower yield. You get $156 per $10,000 invested. Here we can start understanding that yes, SCHD has a higher yield than the general S&P 500 index, and at the same time, we could take a look at some of the highest yielding and lowest yielding companies. The highest yielding IAD yield in SCHD is actually MO or Altria Group. 7.97% is the dividend on this. Now, it's $797 for $10,000 invested into that company. So that's the highest yielding company inside the portfolio of SCHD. And then you have the lowest IED yield, NSP, which is Insperity, and that is actually 1.70, which is $170 per $10,000. What's interesting about this to me is the fact that the average of the S&P 500 is only 1.5-ish% for yield, and Insperity, the lowest yielding company inside of all of SCHD, is 1.70. So the lowest yielding company is actually yielding higher than the average of the S&P 500. So obviously, we're gonna get yield when we invest inside this ETF. Now, the next factor we have is the 5-year dividend growth rate. What is that? Well, what it does is it weights companies higher if they're growing their dividend. So if a company is growing a dividend, it's going to be higher ranked than if a company is not growing a dividend. What does that mean? Well, we could take a look here. SCHD's 5-year dividend growth, 13.7% over 5 years is the average growth rate of the dividend in SCHD. But the S&P 500 index has only been 5.7% for the dividend growth rate. So SCHD has a much higher dividend growth rate than the S&P 500. Again, that's part of the weighting, right? So what it does is it weights higher dividend growth companies, and that's one of the factors it uses. So of course, there should be higher dividend growth paying companies inside this portfolio. And what's interesting here is that dividend growers actually outperform. So here we're looking at a chart from Charles Schwab and its historical returns from 1981 to 2020. It's showing us that stocks that grew or initiated dividends had a return of 13.74% annually over that time period, whereas stocks that didn't change their dividend, so they didn't grow their dividend, or they cut their dividend, had a lower return, and stocks that didn't have any dividends at all had actually the lowest return out of all these stocks. So we could see higher dividend growth is actually good for these stocks. This next factor we have is return on equity. Now, this is a little harder for some people. Return on equity, or ROE, what does it do? Well, the way I interpret why they use this is basically because companies with high return on equities, they tend not to have lots of debt, and they're efficiently creating equity for shareholders. And so I'll show you in a second what that actually looks like, but first, the actual formula is net income divided by shareholders' equity. Now, shareholders' equity, it can be a little confusing for some people. Think of it like the net worth of a company. It's the assets minus the liabilities. Whatever that is, that's the shareholders' equity of the company. SCHD has a return on equity of 30.4%. That's the average ROE of SCHD. The S&P 500 has an ROE of 18.3%. So obviously SCHD has a much higher return on equity than the S&P 500 does, and that makes sense because the weight is towards companies that have higher return on equities, right? Next part, free cash flow to total debt. So zero debt is ranked first. What does that mean? The way I interpret this, why I think this is important, is because dividends are paid through cash flows, so low debt, high cash flows are good for dividend continuity. Because cash flow is important to paying a dividend, if you don't have a good cash flow, you're not going to be able to continue to pay a dividend. Companies also pay their debt through their cash flows. So if a company doesn't have a lot of cash flows, they might not be able to pay debt if they have a lot. And so of course, it's better when companies don't have much cash flow. It helps the potential of the dividend to continue to be paid. We started with the performance of SCHD. We know how it works now, how it uses these fundamental factors, how it defines its universe. The next question is, will SCHD continue outperforming? To figure this out, let's take a look first at SCHD versus VYM. Now, VYM is the Vanguard High Dividend Yielding ETF. I find it as a good comparison to SCHD because Vanguard has great ETFs as well, and VYM has performed very well. What I want to portray for everyone here is the fact that, let's say in the first 5 years of SCHD, it only outperformed VYM in 1 year. So 4 years it actually lagged behind VYM. Why do I tell you this? Okay, the next 5 years after that, we could see SCHD outperformed every single year. So over that 5 years, it outperformed 5 years in a row, and 0 years it underperformed VYM. Okay, why is that important? It's important because I don't know if we're in the first 5 years of VYM versus SCHD or the second 5 years of VYM versus SCHD. Because think about it, what has changed in this since VYM and SCHD were both launched? Nothing has changed. VYM, nothing changed. The methodology that they used is the exact same. SCHD is this exact same methodology as it was launched with. And so when I ask a question like, what has changed? The answer really is the market. ETFs are the exact same. They didn't change. the market is what changes. Sometimes growth underperforms dividends, sometimes small companies outperform large, sometimes mid outperform small, a giant question mark at times. And so we can't always assume that SCHD is going to continue to outperform forever. A lot of you watching this right now, I know what you're doing. You're looking at SCHD's performance since the inception date, and you're saying SCHD has outperformed VYM, the S&P 500, and it is going to continue doing so. And I'm absolutely not saying it's not going to do that. I own SCHD. I think it's a great ETF to invest in, and I'm not saying not to invest in it. Quite the contrary. I'm saying it's a great ETF. What I am saying is I know what it's like to fall in love with an ETF, or fall in love with a stock, or fall in love with an investment or style. And most of the time, if you do fall in love with one ETF or one stock or something like that, it's going to end up at some point in time underperforming. If your expectation is that, okay, it's going to just perform well and it's going to give me good dividends, and who cares if it beats the S&P 500, that's the mentality I think people should have with SCHD. If it is that SCHD is going to continue outperforming the S&P 500 and all other dividend ETFs, that's probably not the way I think this should go. Like, for example, VYM, that are some of its competitors, that may actually outperform it even over the next few years. And it's totally possible. That's just my 2 cents. And if you like this video and you want to watch another video on my favorite Charles Schwab ETFs to buy and hold forever, check this video out right here. And I got a disclaimer here. See you next time.